US job market hits a wall. Tariffs, economic uncertainty. The labour market has encountered a significant obstacle. Experts are weighing in on what this means for both the economy and your employment prospects. A wake-up call for the economy. On August 4th, 2025, the July employment report delivered a sobering update on the state of the US economy, revealing that the job market is struggling due to the unpredictable nature of tariffs that have been inconsistently applied. This report was particularly surprising because it showed that employers hired far fewer individuals than anticipated last month. Additionally, the government made substantial downward revisions to the job data for the previous 2 months, indicating that only 19,000 jobs were added in May and 14,000 in June. This reflects what Chief Economist Gregory Dacko from EY Parthenon described as paltry growth in employment during that period. The latest job statistics are illuminating the current economic landscape as businesses navigate a series of changes, including President Trump's trade agreements and new tariffs, as well as the recent GOP tax legislation. While this tax law offers benefits to many Americans, it also results in reduced funding for essential services, like healthcare and food assistance programs. The job data corroborates anecdotal reports from the Federal Reserve's latest Beige Book, which compiles insights from local businesses indicating that many companies are postponing hiring until there is more clarity in the market. Laura Ulrich, the Director of Economic Research for North America at Indeed and a former official at the Federal Reserve Bank of Richmond, shared her observations with CBS Money Watch, stating, "I anticipated a stagnant jobs report based on what I was hearing from numerous employers, and that's exactly what we received today." She further noted, "The economy experiences fluctuations, and we find ourselves in a rather stagnant phase at the moment. The current job market dynamics. In essence, while there are no significant layoffs occurring in the labour market, companies are also not expanding their hiring efforts. This stagnation can create challenges for unemployed individuals seeking new job opportunities." Recent government data indicates that the number of people searching for work for over 27 weeks has surged by 11%, reaching 1.8 million last month compared to the same time last year. Areas of growth amidst challenges. Despite the overall disappointing report, there were some bright spots, particularly in the healthcare and social assistance sectors, which collectively added 73,300 jobs last month. However, many key employment sectors in the US experienced minimal or no hiring activity, including leisure and hospitality, transportation, and construction. Notably, the manufacturing sector also faced job losses during this period. In a controversial move, President Trump claimed without evidence that the jobs report had been manipulated for political purposes and subsequently dismissed Bureau of Labor Statistics Commissioner Erica McIntyre. He also labeled the downward revisions as a major mistake, despite the BLS's routine practice of adjusting data each month to incorporate new information, which often results in both upward and downward changes. Heidi Shearholz, president of the Economic Policy Institute and a former chief economist at the Department of Labor, criticized the president's assertions, stating, "The idea that the BLS commissioner personally produced the jobs numbers is absurd and reflects a fundamental misunderstanding of how government statistical agencies function." These figures are the result of meticulous work by hundreds of skilled economists, statisticians, and civil servants who adhere to transparent and established methodologies. The impact of tariff uncertainty. Businesses are expressing caution due to the unpredictable effects of Trump's tariffs, as noted by Beth Hammock, president of the Federal Reserve Bank of Cleveland, in her discussions with local business owners. "I've heard that uncertainty is significantly affecting businesses," Hammock remarked. "They are struggling to determine when and how much to invest, leading many to scale back their investment plans. For example, One franchise owner mentioned that they opted to renovate existing locations instead of opening new ones. Trump has asserted that tariffs would revitalize U.S. manufacturing by encouraging companies to relocate or establish new factories domestically rather than incur import duties. Some officials in the Trump administration have characterized the jobs report as a temporary setback while they work to restore American jobs through their trade policies. Stephen Mirren, head of the White House Council of Economic Advisers, acknowledged that while there were aspects of the jobs report that were disappointing, the trade agreements now in place encompass nearly 60% of the global economy. He added that the recent establishment of new tariff rates for numerous countries has alleviated some uncertainty, suggesting that many firms may have been hesitant to invest in May and June, anticipating a resolution to the tariff situation. On the same day, White House spokesperson Caroline Leavitt issued a statement touting a thriving economy under President Trump, claiming, "Inflation has decreased, wages have risen, unemployment remains stable, and the private sector is expanding." The America First agenda has ensured that new jobs are allocated to American citizens rather than undocumented immigrants or foreign workers. The tariffs are generating billions of dollars to restore our nation's wealth. Declining manufacturing jobs. In July, the US experienced a loss of 11,000 manufacturing jobs, with revisions for May and June indicating that the sector also lost workers during those months. This is particularly significant, given Trump's commitment to reviving manufacturing jobs, which has led to new agreements from companies like Johnson & Johnson and Apple to establish new facilities in the US. However, the tariffs imposed by the Trump administration have compounded the difficulties faced by the manufacturing sector, especially for those producing durable goods such as appliances and automobiles. Ulrich pointed out that tariffs on imported metals like steel and aluminum are increasing production costs for many manufacturers, thereby squeezing their profit margins. Scott Paul, president of the Alliance for American Manufacturing, remarked that the decline in manufacturing jobs is not surprising, describing it as another instance of treading water, a trend that has persisted for several years. He expressed concern that the current job count is now 173,000 below the peak reached in February 2023, when total non-farm payroll employment hit 155.4 million. Paul suggested that there is potential for a reversal in manufacturing job trends now that the Trump administration's tariffs and tax policies have been established. However, Ulrich cautioned that achieving the administration's goal of bringing manufacturing jobs back to America may take years due to the time and costs associated with building new factories. Certain products remain cheaper to produce overseas, even with the tariffs in place, she noted. Heather Long, chief economist at Navy Federal Credit Union, concluded, "This is not a healthy job market. The economy urgently requires clarity regarding tariffs. The longer this uncertainty persists, the more likely it is that the current weak hiring environment will lead to layoffs." Employment. Donald Trump. Amy Pitchey is the associate managing editor for CBS Money Watch, where she focuses on business and personal finance. She has previously worked at Bloomberg News and contributed to various national news outlets, including USA Today and Consumer Reports. The future of the US labor market. No growth in workers. There's a storm brewing on the horizon of the US economy, and it's centered around something many tend to overlook: the future of its workforce. While headlines often focus on quarterly earnings or stock market swings, some of the most influential voices are raising alarms about a potential scenario where the growth in the number of workers altogether stalls. And it's a possibility that could reshape everything we thought we knew about economic expansion. But here's where it gets controversial. Could the next 5 years actually see no increase in employed Americans at all? One of Wall Street's top strategists, David Kelly, chief global strategist at JP Morgan Asset Management, has issued a stark warning in a recent analysis. He points out that due to demographic shifts and sweeping changes in immigration policies, the US workforce might remain unchanged in size for 5 years or more. This isn't just a minor slowdown. It could be a complete standstill, with profound consequences for both the Federal Reserve and investors alike. Kelly's insight stems from a detailed review of the recent labour market data, especially the shocking revisions to July's jobs report. The figures showed that in May and June, job creation was revised downward by 258,000 positions, and July's addition of only 73,000 new jobs fell well below the expected 110,000. Over the past quarter, the average monthly increase was a mere 35,000, indicating a sluggish recovery. Meanwhile, the unemployment rate nudged upward to 4.2%, and both employment levels and labour force participation continued to decline. One of the stark indicators Kelly highlights is the labour participation rate, the percentage of working-age Americans actively working or seeking work, which dropped from 62.65% in July 2024 to 62.22% in July 2025. This decline translates to nearly 1.2 million fewer people aged 16 and over either working or trying to find work. While part of this decrease is linked to aging into retirement, Kelly notes that participation is also falling among younger groups, aged 18 to 54. These signs of a tightening labour market are more than just numbers. They signal a deeper, structural challenge for the economy's future. According to census projections, Kelly references, the population within the prime working age, those 18 to 64, will shrink in coming years if immigration levels stay low or decline further. Specifically, the population in this bracket is expected to drop by over 300,000 between now and July 2026, with this trend continuing into 2030. The shrinking workforce, driven by retiring baby boomers and reduced immigration due to policy shifts, suggests slower potential growth for the economy. This looming squeeze presents a dilemma for the Federal Reserve. On one hand, political pressures, especially from leaders like President Trump and his allies, push for lower interest rates to counteract tariffs and support faltering markets. On the other, Kelly warns that cutting rates in an environment where the labour market is already tight could backfire, igniting wage price inflation rather than boosting growth. It's a delicate balance, one that becomes even trickier given that the economy has been gradually growing at about 2.1% annually since the early 2000s, with much of that driven by workforce expansion of roughly 0.8% each year. Kelly's sobering forecast suggests that if these demographic and immigration trends continue, we could face a period where the workforce simply doesn't grow. In such a scenario, economic growth might slow down permanently, but without triggering the inflationary pressures that often accompany rapid expansion. To Kelly, this means the Federal Reserve should tread very carefully with rate cuts, and investors are advised to temper expectations for rapid gains or markets fueled by easy monetary policy. The notion of American exceptionalism, the idea that the US can continuously outperform other nations, begins to look less certain if growth stalls. The overarching message, the days of relying on a broad, ever-increasing labour force as an engine for economic prosperity, might be coming to an end. Instead, we're faced with questions about sustainability and the potential need for new strategies to maintain economic stability in a world where workforce growth is no longer guaranteed. What do you think? Are these projections overblown, or is this the new reality we need to prepare for? Would love to hear your thoughts or disagreements in the comments. The shocking jobs data revisions. What happened? What happens when a single data revision shakes the foundations of economic reporting? A recent storm in US labor statistics has left experts and the public alike questioning the reliability of key employment figures. And the consequences were nothing short of dramatic. The story begins with a massive downward revision to payroll data for May and June 2025, which led to the unprecedented firing of Erica McEntaffer, then Commissioner of the Bureau of Labor Statistics, BLS. But here's where it gets controversial. The scale of these revisions was so staggering that it sparked a firestorm of political and professional debate. Could this be a sign of deeper issues in how we track the economy? Or was it a case of data simply falling into the wrong hands? Let's break it down. The BLS typically releases its monthly non-farm payrolls report on the first Friday of each month. This report includes an initial estimate for the most recent month and revisions to the prior 2 months. These revisions aren't arbitrary. They're based on additional survey responses and updated seasonal adjustment factors. However, the May and June 2025 revisions were anything but routine. The combined downward adjustment of 258,000 jobs for those 2 months was the largest since the early days of the COVID-19 pandemic, and the largest outside of that period since at least 1979. To put this into perspective, the median revision for 2 months combined estimates since 1979 had been an upward adjustment of 10,000 jobs. This time, the numbers flipped entirely. Let's dive into the specifics. The first revision for June alone saw a 133,000 job reduction from the initial estimate. Over the past year, the BLS had revised down 8 out of 12 monthly payroll figures. While downward revisions aren't unheard of, the magnitude here was extreme. For example, the median revision in the 3 years before June 2025 was a modest negative 10,000 jobs. Compare that to the pre-pandemic decade, where the median revision was a plus 8,000 increase. This shift suggests a systemic trend in how data is being adjusted, raising questions about whether the initial estimates are overly optimistic or if the revision process itself has become more aggressive. The second revision for May added another layer of controversy. The third estimate for May's payrolls was cut by 125,000 jobs, the largest downward revision for a second adjustment since March 1983. That's a 42-year gap with no comparable precedent. When combined with June's revision, the total adjustment of 258,000 jobs dwarfed all non-pandemic era revisions. Even in absolute terms, this ranks among the top 4 largest revisions in history, alongside the chaotic months of 2020 and 2021. For context, the only larger revisions were during the pandemic's peak, March-April 2020, minus 642,000, and the post-pandemic rebound, November-December 2021, plus 709,000. And this is the part most people miss. The implications go beyond just numbers. The BLS is supposed to be a neutral arbiter of economic truth. When political leaders react to such revisions, like President Trump's decision to fire McEntaffer, it raises uncomfortable questions about the independence of statistical agencies. Was the firing a response to the data itself, or to the political fallout it triggered? Could this set a dangerous precedent for how future data is handled? The controversy doesn't end there. Critics argue that the BLS's reliance on complex seasonal adjustment models might be contributing to these large revisions. For example, if the models fail to account for sudden economic shifts, like a tech sector boom or a manufacturing slowdown, initial estimates can be wildly off. But defenders of the BLS point out that revisions are a normal part of the process, and that the pandemic-era data was an outlier due to its sheer scale and speed. So where does this leave us? The May-June 2025 revisions are a wake-up call. They highlight the fragility of economic data and the risks of treating it as gospel. For policymakers, businesses, and everyday Americans, these numbers shape decisions, from interest rate hikes to hiring freezes. If the data is prone to such dramatic revisions, how can we trust it? And what safeguards are in place to prevent political interference in the future? We'd love to hear your thoughts. Do you think the BLS needs to overhaul its methods to reduce the need for massive revisions? Or is this simply the cost of navigating an unpredictable economy? Share your perspective in the comments below. After all, if the past year has taught us anything, it's that the numbers don't always tell the whole story.